Good afternoon. Good afternoon, everyone. Welcome to our detailed outline of our global investment strategy thoughts for the third quarter of this year. We will go through this again, maybe not in so much detail when we meet with you for our quarterly investment committee meetings that are beginning on Monday. I'm going to kick off, I think, with our thought process, and I should sort of be with you for roughly an hour and 15 minutes. We unfortunately did not take questions for this particular session, but again, you're welcome to start sending the questions that you want addressed in a lot of detail when we meet you again, effective from Monday, I think for the coming 6 weeks or so, till after the end of August. So just a quick reminder, we're going to focus a lot on the investment objectives as has been seen by the investments team according to the different mandates, most of which are really seeking to target inflation plus benchmarks. We understand that after this particular presentation, you are going to take into account any areas of tension with your client objectives, and you are also going to consider what is really worthwhile for your business. And ultimately, by the time we conclude our investment committee meetings with you in the coming weeks or so, we will find that optimal balance that works, that meets the investment objectives in the interests of your clients and your business risk. Much of the process, essentially all of our investment decisions are designed to systematically feed into 30 different mandates, which I've sort of shown you across. And we know that your product range fits one or two or three of these particular areas. But I guess the guarantee we can leave you with is that all of these mandates are reflecting one house view, which is, I think, the outcome of decisions made collectively by a 7-member investments team at Apex Investments Consulting South Africa. And again, we don't believe in forcing our clients into one particular aspect. So if you look at one single mandate, for example, your South African multi-asset low equity fund, it has, again, 4 variations just to accommodate what it is our clients feel comfortable with. So for example, if you look at global equities, there are certain clients where global equities must be restricted only to developed equity markets, which is the first 3 mandates. But we also have clients who are quite happy to consider this 25% allocation to emerging markets out of the 16%. We also have clients who are willing to consider global property, but their mandates designed for clients who don't really want that type of asset class in their solutions, and etc. Similarly, for asset classes like inflation linkers, some clients will say, look, I'd rather lump that into my nominal bonds. I'm not really comfortable with that asset class. I think the key message is that we are always going to run this in a partnership and collaborative effort and not force any one particular solution on our underlying clients. The ultimate risk control in our decision making is the macro regime framework. And what this really is saying is that for as long as we are in what we call the euphoric regime, and typically this is after the US bond market yield curve inverts, we prefer to be very, very defensive growth assets and start to express a lot of conviction towards defensive assets. And here we're really talking about global bonds, nominal bonds, and inflation linkers. And on uncorrelated assets, typically it is the US dollar as well as gold, depending on valuations. According to the work, I think, done by Bank of America Merrill Lynch, that you can see pretty much in front of you, this euphoric season where we are in a defensive mode typically lasts between 0 months and 34 months. We kicked into this particular season in May 2022. And according to this particular study by Bank of America Merrill Lynch, this will be the case until we get to March next year. So we're pretty much about, maybe if I look at September, October, November, December, we're about 9 months away from March, where we may be in this de-risk state, all else equal. This has probably been one of the most frustrating euphoric season for us, in the sense that it's taken so long to play out, and it's been very frustrating as well. So typically, if you look at how macro regimes work out, so for example, this work looks at many different equity market cycles. The first 10% or the first decile of any equity market is typically where you get the most powerful returns. So as far as building proper long-term track records, you don't want to miss out on this first part because it happens after a crash. It happens when your earnings have bottomed out. It happens when interest rates have peaked. It happens after the Fed maybe starts to cut rates. It happens so fast. So you really want to capture as much of that as possible. And then you want to avoid as many as you can of this last part of the bull market because often it has got the most dangerous returns. You can make a lot of money if you're able to stay in at the right time and get out at the right time. However, if you're not capable of trading, it's really not worth playing out. So as you would know, with our portfolios, we've been underweight developed equities, developed market credit. We've been underweight the dollar to some extent, underweight global technology, DM growth, DM quality, because they all fit this particular profile where they can do very well and close the bull market cycle on a strong note. However, they tend to sell off quite fast. And in the month of July alone, we've seen 2 consecutive days where this particular asset classes have sold off by just over 3% in a day. And all of this has really happened in the last week of July. And yesterday, we saw again a repeat of the same ideas pulling back by almost 3%. So really, I think our process does not have any intention of participating in this dangerous part of the equity bull market. We prefer to come in here where everything has crashed and we're now waiting for good news. And if you sort of look at the ideas that fit into this first part of the bull market, it's South African equities, Chinese equities, emerging market equities, all the way to the Japanese yen. And the areas that we have highlighted in red are areas where it's not working out for us. It's been a very frustrating wait. And this really means Chinese equities, global property, global bonds, and global ILBs. The rest of the ideas are slowly coming through as much in exactly the same way we anticipate for the first DISA. So you would have seen after the formation of the Government of National Unity, how for the first time South African equities came in and gave us this bounce. And we expect to actually experience a lot more of this first decile out of South African equities, and we are positioned as such. South African bonds and South African IOBs also really started to really come through around the same time. And when we say frustrating, we're really saying from May 2022 until maybe May 2020. In fact, actually, yeah, from May 2022 until May 2024, we were waiting for South Africa to come through, EM to come through, SA property to come through, SA bonds to come through. And it has played out despite a very long and painful wait where it felt like I think we'd got things wrong. We are very encouraged by the fact that it's really worked for more than half of our ideas. We are, however, still waiting in anticipation for China equity, global property, global bonds, and global ILBs. And what we've seen happening in July and August is starting to give us some conviction that we're probably right, that this is not the right time to play out and extract value out of the areas we've highlighted in red. So I think what you can sense is we're generally starting to feel a little bit confident about our macro regime-based process. And obviously, what would be a macro regime process without talking about gold, which you typically want to hold throughout the deciles because you never know when geopolitical risk will strike. And that strategy has played out well for us in the sense that gold has really done well in the 2-year period we're talking about. But as I'll show you later, we do believe that it has got slightly more to go, all else equal. So that's it on the introduction. We're going to quickly touch on the recommendations we made last quarter and have a quick accountability check of what worked and what didn't work, and what do we think about what is not working, as well as what is working, just to get a sense of how that affects your portfolio positioning. Our first call last quarter was that was the last opportunity we believed we were going to get in this cycle to be overweight bonds, but not only to have the maximum allowable bonds, but to maximize duration risk. So we introduced this duration calculation tool where your multi-asset income funds, we assumed, have a midpoint of 1.5. Your unconstrained or medium duration managers like your Portfolio Metrics, Visio, Saffron Active Bond, Coronation Active Income Plus have got a midpoint of 3.5. And then your pure bond funds, a midpoint of 6 years. And we sort of gave you a sense of the duration risk you introduce in your portfolio with the different blends of fixed income. And I think your role together with the 2 BIP portfolio managers Apex portfolio managers that work with you was this to establish the current blend in your fixed income carve out and then discern if the resultant duration risk was aligned to what your mandate is. We also gave you calculations of what, so if you look at a multi-asset low equity fund, these are the benchmarks we've already gone through. If you extract fixed income out of this benchmark and multiply the weight, for example, South African nominal bonds at 25%, multiplied by the midpoint was 6%, you end up at 1.5. Similarly, South African inflation linkers at 10 multiplied by the midpoint would give you this particular number of 0.6. And in total, you would find that a typical multi-asset low equity fund has got a strategic duration band of between 4.55 and 4.65. And your role together with the Apex PMs was to make sure that we identify a blend where the duration risk is 4.55 at a minimum. So if you're combining unconstrained managers and bond managers, that would be around a 60-40. And then if you're combining multi-asset low and unconstrained, you wouldn't be able to achieve that. And if you're combining multi-asset low and high duration, which is your bonds, you would achieve that at a selection of about 30-70. And then to then achieve the 0.5 overweight, you would then need to increase that to a 20-80 or 30-70, just depends on the managers you like. But this really was the way we achieved our overweight by 0.5 years to 1 year duration risk. So just to repeat that, for the peer group benchmark, 4.55 years plus a 0.5 would end up being a 5.05 duration, which means we target anything with 5 years in this blend to achieve that. So that was one of the first calls we made. We also, I think, made a confession that for the 20 years that we've been managing money, we cannot give you examples where capitulation actually added value, whether it's because clients eventually gave up on maybe something like the Alan Gray Balance Fund because it went through an extended pain trade. You would find that the funds they bought afterwards often did a lot worse in the subsequent 3 to 5 years. Whether it was PSG, again, a recent example, whether it was gold, actually, which despite doing well recently was a pain trade for a long time, you find when you capitulate, you're obviously going to buy what is doing well at that particular point in time. And when you then do like a cost-benefit analysis with the 3 to 5 year horizon, we've never really seen capitulation add value to clients. So we sort of strongly advise clients to say, look at your original position size, assume it's 5%. Assume your investment horizon is at least 3 years, because most of these ideas have got a 3 year time frame. Divide that 3 years by 12 consecutive quarters. So you might convert the 3 years into a number of quarters and then divide the position size by the number of quarters, which means that you can reduce gradually by 42 basis points, which we approximated to be cleaner at 50 basis points and reduce only to 50% of the position size on condition that as the markets start to reward that idea, would automatically rebalance back. So this allows us to reduce pain trades only to 50% and remain invested, because typically the reasons why we would have got into that idea would remain intact. And the only time we then encourage a complete capitulation is if there's a complete turnaround in our house via an investment process. So this really is starting to defend our performance track records from regret risk, where you're like, well, we shouldn't have actually capitulated on PSG. We shouldn't have given up on coral. We shouldn't have given up on bonds. We should not have given up on gold. We shouldn't have given up on China. So essentially, we're just saying to our clients, as a default, Apex Investments Consulting really is strongly discouraging you from complete capitulation. Rather have a gradual reduction to half of your position size. And as soon as the scenario turns, go back to whatever the house view weight would be for your different investment mandates. And this particular recommendation still stands, all else equal. So for multi-asset portfolios where we're combining different balanced funds, we're still, I think, advocating a style neutral exposure. We are still advising for clients to never have more than 12.5% per fund, because these are some of the reasons why when a fund is in a pain trade, it starts to explain a bigger and an unnecessary aspect of your outcomes. Whereas at 12.5, you can afford to have 2 managers, and if both of them are in a pain trade, only a quarter of your portfolio is struggling. Whereas you allocate more than this per portfolio easily, 2 managers get it wrong, and 1/3 of your portfolio is struggling. So we still strongly advise against manager exposures that are higher than 12.5% or else equal. We are advocating for a defensive block allocated to multi-asset income funds according to the duration tool we talked about. And these are some of the unconstrained managers we have, which are on our buy list for those clients who really want a lot of duration risk, but don't like the volatility that comes with pure bond funds. This would be nice replacements to that. And because we're still seeing China as an idea with a lot of upside, despite the way the Chinese policymakers are resolving their issues in a slow way, we think it still supports the significant upside. And there we continue to advise an allocation of at least 5%, and even went as far as saying we want to take this up to 10% if the recovery becomes a lot more convincing. So generally, it's been a very painful idea. We see a lot of upside, and we cannot see many ideas with such comparable upside in our big global universe. Otherwise, we would not have been this consistent in supporting this idea, despite the fact that it's at us for quite a long time. So if we finish off and look at this in a more visual way, we're underweight your growth balance funds like ABEX by 3%, your quality managers like 91 Opportunity by 3%. Value, we're looking at Coronation, we're looking at M&G, again, underweight by 3%. Momentum, we're looking at managers like Gales, 91 managed. You're looking at Metrics Balance Fund. Also, they're underweight by 3%. Methodical, on the BCI front. And market beta is pretty much funds like your Satrix, Net Group, Core Shares, also underweight by 3%. And that is going to China initially at 5%, but with that intention to take it up to 10%. And here we're using a balanced fund as well, which is the Prescient China Balanced Fund. And then the rest remains in a defensive block. And if you look at this R, we also mentioned that as our re-risking criteria are triggered, we're willing to start adding to this mix equities before we then take all of those to a normal balance fund as the cycle progresses. So if we have to summarize the name we can give to this particular strategy, I know that last quarter we referenced ourselves as the bond kings. This particular quarter, if we have to keep it a bit dramatic, maybe let's just call it gold is my China, my bonds. So my China, my bonds is pretty much our strategy and our gold for now. But as equity markets sell off, we run away from these defensive assets and become quite aggressive. So on the dramatic and saucy side, our strategy for this quarter, gold, my China, my bonds. And then if we look at your specialist building block strategy, avoid complete capitulation remains our strongest advice. I think I've taken you through that in a lot of detail. Do not have underweight fixed income. Do not have underweight duration risk. We don't think we're going to have the same opportunity to buy bonds again. So last quarter, when we met you, bonds had sold off locally and globally. And we pretty much say, guys, this is our last chance to go all in. Otherwise, we're going to regret. We continue to say, please go all in because bonds are only now starting to come through. So, and then number 3, we said avoid under allocation to fixed income. Thankfully, from last quarter, SA unconstrained fixed income has done really well. Nominal bonds have done well. ILBs have done well. And the ones in red have not yet come through. So they still stay in our pain trade list, which is your global nominal bonds and global TIPS. We really love global bonds going forward. We love global ILBs. So to some extent, we're still your bond kings that we were last quarter, except this time around, it's on the global side. Gradual increase of global real estate and local real estate. Property is quasi-bond, quasi-equity. So to the extent that we really like bonds, that bond nature of in property will respond to the rally we're expecting in nominal and inflation linkers, hence the way in which we are constructive on property, but not to the same extent that we are in bonds. Otherwise, we'd have had my China, my bond, my property, but it's not yet that long. But again, we are gradually adding to both. We're still cautiously neutral towards EM, but are very aware that EM has held up very nicely in the last 2 years. We haven't seen any accidents in that area. The dollar has peaked. Earnings have bottomed out. Central banks are ahead of the curve in controlling inflation. It's a globally hated idea. So when global investors start to come back, it really could have a global rally. It is again supported by the recovery in the manufacturing cycle, recovery in China. You can see there's a lot of reasons why you can't be negative on EM, and hence our caution or cautiously neutral stance, where we're happy to be marginally underweight, neutral, marginally overweight, but nothing dramatic, particularly for this particular asset class. We retain underweight DM equities. It's been a very, very painful trade, this one, in favor of bonds and IOBs, but we think we're starting to get rewarded, as I'll show you later. South African equities in the 2 years that we were de-risked meaningfully struggled relative to EM equities and DM equities, which means our core was actually quite right because that was our bigger underweight. We were an underweight of 10%, whereas we're only underweight DM by 5 and neutral EM. So that South Africa lagged for so long really played into our positioning. However, we got to a point where we're like, you know what, we don't like SA equities, but they really have struggled and things are starting to turn. And essentially, this is the second quarter where we're gradually adding to SA equities, if not the third quarter. And that, again, proved to have been well timed because as soon as we started adding, with the surprise good political outcome, and your SA equity started to rally. And we seem to have been lucky again. Our timing of adding SA property was again on point. Our timing of adding SA bonds was again on point. So far, it looks like this cycle has been very, very kind to us, but we still want my China, my bonds to come through and give us the final conviction we need that our process is working. And then I'm just going to skip a few things because I think you're all familiar with sort of where we are. Value and small caps, we've struggled, but we've added a little bit and we expect those to do well in the rotation that's coming through. We argue that Japan had done well and it was time to close it. It turned out we were correct. And then retaining our thematic plays, which is global gold, that has worked. Global technology, which we are playing via growth and quality managers, that has worked. Global commodities did not really work, unfortunately. So again, global commodities, global bonds, and global tips not really working and supporting us. And then for China, we argue that we love China, but it comes through in two different universes, the offshore listings in Hong Kong, and then the A-share listings in mainland. And we actually argue that whenever you're bullish on China, they don't quite behave the same always. Sometimes the A-shares rally before the H-shares, and sometimes the H shares rally before the A shares. So we decided to go with a 50-50 blend. The H shares worked very well. The A shares did not work very well. And again, that would be our third, if not fourth red idea. And then finally, in terms of offshore, because DM is expensive, the dollar is expensive, South Africa is very cheap, EM is very cheap, China is very cheap. We made a decision that we would not go overweight offshore. So we restricted our offshore maximum to 30% for clients who were not keen on China. And then for clients who were keen on China to the extent that we're recommending 5% currently, maximum there was put in at 35%. And we remain convicted that there is no need to chase the offshore maximum of 45% yet. The time shall come. And at that particular point in time, we'll start to move offshore. But for now, we actually are more bullish on the local side than we are on the global side. So had it not been for that, for our ability to allocate to emerging markets and China, we would obviously be a lot lower on the offshore side. So all of our investment recommendations in the last quarter, pretty much most of them worked out with the exception of those in red. So out of these 12 recommendations, 8 worked, 4 failed. So I guess from a pass mark perspective, you probably would give us a 75% pass rate. But then would also argue that maybe we deserve a higher mark because we don't believe that global bonds, global tips, and then your A shares are to be written off as yet. So in general, my China, my bonds gets a 75% pass mark. And I think I'll just continue to remind you of that strategy name just to sort of shift out of this. So in terms of how we're positioned, the green areas are where the investments committed Apex is very constructive. So the first one is SA IOBs, we've got an overweight of 2.5. SA nominal bonds, we're overweight by 5. Chinese equities, we're allowing an overweight by 5. DM IOBs, an overweight of 2.5. DM nominal bonds, an overweight of 2.5. And then gold, an allocation of 5%. So again, really the strategy to remember this is that gold is my China and my bonds. And these are two different strategies that we follow. The first table and the second table are actually quite similar. The only difference is that the second table is slightly watered down because it is for those clients who are slightly risk conscious or risk aware, or it is not as it is for clients who are not as aggressive as the two. So we're also accommodating very aggressive clients and not so aggressive clients, but the characteristics of the strategy remains gold is my China, my bonds, because they all have it except in different nuances. So to give you a sense of how that works, if you look at global gold and as example, our more restrained clients will only have 3% maximum, whereas the aggressive ones will have 2% extra. If you look at an idea like China, the more constrained clients will not allocate more than 3%, and the very aggressive clients will have it up to 5%. Some of our clients have even taken this to 10% and argue that it's a no-brainer. Nothing is as bombed out as this, so we want to double it up. And we have done so for them and figured out how to balance out that aggression in other areas. But generally, the flavor of our house view remains gold is my China, my bonds. And then if you look at the global space, it's exactly the same thing. So I'm not really going to spend any time on this particular one. And then finally, on investment styles, we have been neutral all styles locally and globally, except on the global side, it's very unclear to what extent AI is going to continue to dominate performances. For most of you that have been following the Apex Investments Consulting's process and philosophy, you will know that in the 2 years that we've been de-risked, we've continuously brought in the 1995 to 2000 area as a regime where there was a higher for longer Fed rate cycle similar to today. And what was also similarly interesting in that particular regime is that that's when we had the internet boom that then drove the S&P 500 into a mania territory where it continued to dominate other global equity market despite being expensive. And all of that was really driven by technology. And because AI is playing out exactly the same way that the internet boom played out in the mid-1990s, combined with the fact that it's also exactly the same time that the Fed was in a higher for longer scenario, we're finding that the similarities between these two suggest that quality and growth managers may continue to dominate other investment styles because they are more disposed to global technology. And for that reason, because we can't really fit in AI into a traditional risk management process like ours, it's a very new concept. So we decided to reflect our lack of knowledge and our lack of conviction by being marginally overweight. Otherwise, we would not have been. But it's an admission that at this point in time, we don't know what's going on, but historical precedent suggests that it can carry out and carry on for longer than anticipated. Otherwise, we would not have had these overweights. So if we then move on to performance, first of all, I think our recommendation to maximize bonds and our argument that it was probably the last chance for our clients to load up on bonds really played out well. You can see that South African bonds did well, up by 5.24 in closing the quarter. Property, being a hybrid between equity and bonds, benefited from that with a stronger performance. So again, our argument that property is a hybrid of equity and bonds. When you like bonds, there's an aspect of property you like. That argument proved to be correct with this strong outperformance that you're seeing. Unfortunately, Chinese A shares, which you can see right at the bottom, really are not working through for us. They closed the quarter on a very, very painful note, all else equal. And then if we sort of look at investment styles, last quarter when we saw you, local value and global value were dominating this performance charts. Where are they now? You can see they're pretty much gone back to number last. So that's a very painful one, from dominating to back to number last. It just shows you that within the equity carve out, there's a lot of noise in these investment styles. And we manage this by having an equal allocation to all of these styles throughout the cycle, with a few exceptions where we take marginal overweights. So this means that although there's a lot of noise in styles, because of the way we construct your portfolios, you don't experience that in a binary way where your equity cover is either up or down, because of how we've just kept an equal blend, except for extraordinary situations like AI, where we've taken a marginal overweight of not more than 5%. If you sort of look at where these bands are. So the key message is that, yes, we do experience a lot of noise at investment styles, but we've devised a portfolio construction approach such that you are not overly exposed to these particular styles. And then if you look at the different ASISA categories, the one message we want to leave you with is that our house has continuously argued that the rand is too cheap, the dollar is too expensive. And one of the reasons why we have decided not to go more than our neutral offshore was because South African multi-asset funds have got a history of always being caught out on the wrong side of the rand. Whenever the rand recovers aggressively from oversold levels, everyone is overweight offshore. We've just decided not to be part of that statistic, specifically because our house view was signaling that. And you can see again in the final part of the quarter, a lot of the offshore performances were dragged down by the rand, whilst your South African bonds, again, remember we declared ourselves to be the bond kings last quarter, and that really came through for us as we closed the particular quarter. But the key message here is just the effect of the rand, which we think is going to continue on a forward-looking basis. If we move on to the quarter, our allocation to China worked well, yay, but the sad part is it's only half of the core, which is your H shares, and the other half, which is the A shares, did not come through. And what's even more painful is that performance differential between the 10% and the loss of 5 is like a 15% gap. So much so that the overall China gap is kind of just flat because whatever the H shares made, the A shares took away. So this is one way we're still really anxious. We really want to see all ideas come through. Our South African equity core worked well. Our South African bond core worked well. Our global gold core worked well. South African property core worked well. So pretty much a lot of our cores, even emerging markets, if you look at where emerging equity markets are, they're pretty much one of the better ideas on the offshore. So we've had a quarter where our views have generally played well. And Japan, which we decided to close, was the worst. So again, from a tactical timing, the systematic process signals we've been designing over the last 20 years look like they're really coming through for us. Investment styles. If I have to look for good news, the good news is that global growth and global quality did better than the other factors. So that overweight, which is explained by us not understanding things like Meta, things like Alphabet, things like NVIDIA, that looks like it's really working well, all else equal. And then your local styles, as you'd expect, really came through quite strongly on the basis of, I think, the recovering South African market, whilst the global small caps and global value are lagging. And these are the areas we want to add to because they've been underperforming for way too long. And then again, if we come back to the categories, you can see that our global bonds and global property, they really continue to cause us a lot of grief. So this is an area where it's causing us pain, but we know they're going to come through. If anything, what has been happening the last week of October and yesterday, the first day of August, sort of gives us conviction that we really do need more bonds. And we continue to advise our clients, maximize your global nominal bonds, maximize your global inflation linkers, gradually add your global property, because that area on the global side has been on the back foot for too long. And I think it is due for a strong comeback, and we really are well positioned for that, all else equal. Finishing off with a 1 year, I think 1 year view of everything else. We do not like the fact that US equities continue to punish us despite looking very expensive. So that really has been a very painful part for us. And we also don't like the fact that our global bonds in China have worked against us in the last year. So if you look at the 4 areas of trade of pain, it is pretty much my China, my bonds working against us. But everything else really, I think, is played out as we anticipated in those last 2 years. So from an investment style perspective, we love the laggards of the last year, which is your global value, your global small caps, and pretty much all the local equity investment styles. And we're pretty much adding to local equity, but not yet adding to global value and small cap, because there we want to buy bonds first and then value and small caps after your bonds have given a good rally. So in terms of your peer group categories, our biggest expectation in the next 1 year is this good rotation from global equity, particularly DM, in favor of bonds. So again, if you look at a lot of recommendations that your Apex ICPMs are going to bring you this quarter, is where you held too much DM bonds. DM equities, my apologies. We're just asking you to make this rotation in your portfolio because we're expecting to see a performance rotation out of global equities into global bonds, or else equal. So we really still bond bulls. We really still declare ourselves we're the bond kings, but this time around it's the global bond kings because the local one is starting to really work in our favor. So just to finish off, everyone is talking about soft landing. So we thought we could sneak it in. And the way we're going to sneak it in is that our systematic house is actually landing softly. So for the 2 years, a lot of the calls that were causing us a lot of pain because we decided to forgo upside and protect your capital, a lot of those are starting to be justified. They're starting to be supported by the market, even though they took so long. So originally, if you look at the bullet points where my cursor is, all of those were the defensive ideas we ran our way into as we reduced our global equity exposure. And nothing worked actually in a lot of these ideas, with the exception of maybe In fact, global growth and global quality also kind of didn't work because initially we were underweight, and then we realized that was not a good call. But again, as the 2 years have unfolded from May 2022 to May 2024, everything where we've got a green started to work well. So our global growth idea worked, global quality worked. Our gold allocation started to come through, our EM came through, our SA bonds came through, our SA IOB came through, and the only one that hasn't really come through, again, if you look at the last 4 points, is again my China, my bonds. But in the last week, we've started to see global bonds coming through quite nicely. The Chinese equity, half of it is working, half isn't. So even there, it's not a complete fail. So you could say after 2 years of de-risking and re-risking, we believe that our systematic house view is landing softly. So far, our past mark is 75%. Obviously, that's our self-assessment, but we do hope you give us the same, if not higher. So I want to talk about drawdown analysis because we're actually very excited about the sell-off we've been seeing since last week. Obviously, no one wants to see equity market sell-off, but when you've been positioned for that and you're starting to look like a fool because it looked like you got it all wrong, you really are celebrating. We haven't started popping the champagne bottles yet, but we like what we're seeing. So let us start off with DM equity indices. You can see how that has started to come down. We love this because we've been positioned for this since 2022, and we were right, then we're proven wrong, we're right again, and then it's just been a mess throughout this de-risking process. So this is what we meant to say. The evidence never allowed you to breathe and think it's time to go back into DM equities because they kept selling off and rallying. And so far, this particular one, we do think that it's really going to continue to pull down because interest rates are now at the maximum peak, whereas in all these other times, interest rates were not yet as painful as they are today. So in all of the charts, I'm going to show you the red text box represent your correction territory, which is a loss of more than 10%, but not more than 20 for a period not longer than 3 months. So we're pretty much expecting losses of more than 10, not more than 20 in the coming 3 months to the end of September, which is the thing and the event that we think is going to justify our aggressive allocation to global bonds. So if we move on and we look at MSCI World, excluding the US, you get the same picture. We're starting to see a bit of a sell-off. We love it because we've been advising that this asset class is really expensive. If you then break it down and you bring it into the S&P territory, again, so far in July, heading into August, we're seeing this downturn, which we think is heading into the red text box. But let's see, maybe we're wrong and overexcited, which is why we've not popped any champagne bottle yet, but we do think we are going to pop a few. And then if you look at the eco-weighted, again, we're starting to see some downturn, and we believe we're heading into the red text box for that particular asset class. And then if you look at the NASDAQ, that one is really going for the red box. And I think after yesterday's loss of 2%, I think it's now in correction territory. So what do we do when something enters correction territory? Because as you can see, when you enter correction territory, you either get worse, but ideally snap back quickly. So what this really means is, are we going to send you an email in the coming 2 or 3 to say, the correction text box has been hit, we want to start to add DM equities or not? I'm going to sort of leave you with this question and I'll answer it throughout the rest of the slide decks. But this development that we are seeing, we really think that finally our underweight DM and overweight bonds, which is the last part of our de-risking trade, is coming through. And after that, we reset into a normal market cycle where we might reset all of your asset classes back to neutral. And then we start again this whole process of thinking who's going to be overweight now, because now we're looking at rate cutting cycles, which is good for your growth assets. And then if you look at MSCI All Country World Index, again, so far in July, it's been selling off a little bit further away from the red box compared to the NASDAQ, but nonetheless, the direction is of equity markets sort of giving off some steam recently. Emerging market equities, the same story, giving off some steam and heading into the red box. And then if you look at China, this is what makes us so excited about China, in the sense that it never even recovered out of bear market territory. And yet policymakers continue to support it, the economy. They continue to address the real estate market. They continue to cut rates, but very slowly. So this is the only asset class that is in bear market territory. And bear market territory is when the loss is higher than 20 for a period longer than 3 months. And with China, literally, it's been doing this literally since we de-risked our portfolios in May Aug2022, which is around this particular area. Unfortunately for us, we held on, so we've been going through this roller coaster, which is why we're saying that this euphoric period for us has been very, very frustrating and very, very painful. But we have not lost our conviction that China is going to get out of bear market territory, enter correction, and enter a normalized environment. We just don't know when that's going to be, because we really don't think it's about timing the market, but rather about time in the market, which I think we've demonstrated in the last 2 years. So this one, we're very excited, but obviously from a place of pain, because we've been in the loss territory for literally the entire de-risked period of our strategy. Again, it's the same thing, whether you're looking at H shares or A shares, the story is the same, and hence we love both H shares and A shares when it comes to the Chinese market. South Africa, much better drawdowns in the recent sell-off. We are expecting South Africa to also have much better drawdowns even in this particular correction, because it's deeply under-owned, very attractively valued. So again, relative to DM, a better place. However, we've allocated more money to South African bonds than South African equity, despite the fact that its valuation buffer has given less drawdowns compared to the other equity markets we've sort of shown you a lot earlier. And then this is still the all share. The first one was the SWIX, same conclusions. I'm not going to go through this in any detail. And then property, South African property, we started adding to South African property almost a year ago, and we pretty much seem to have timed this particular last drawdown quite nicely. And ever since, it has really come up quite nicely, where we've been gradually adding in steps of 50 basis points. We're now sitting at 4% at a minimum across all of our strategies in property. And that has been the good call to make on the local side. On the global side, unfortunately, that has not been a good call to make, all else equal. And again, just to show you how, when we started adding this again, sometime last year, we had reached the 20% maximum of drawdown. We are monitoring this chart, obviously, and we will see what ideas come out of that. Global property, we're still excited. It has failed to break out of correction phase ever since we de-risked the portfolios around this particular time. I think we'd finished our de-risking up to then. It's been a roller coaster ride where sometimes we really look smart, then we kind of look like we lost the plot. It's just been too much volatility for this idea. But in the middle of all of this, we've been gradually adding in steps of 50 basis points, because we do think once you start to see rate cuts, property being a hybrid of equity and bonds, the bond nature will kick in, and we're expecting this to come out of correction phase, and hence the excitement we have on a forward-looking basis and the pain we have from the scars of the past, if you look backwards. And then bonds, you can see again, global bonds have not come out of correction territory, hence the reason why we like them and we're very bullish on them. Local bonds, however, have behaved much better. I mean, yes, there's been a lot of volatility, with losses ranging between 0 and 4 at any particular point in time. But despite this volatility, I think the yields have come through. So I mean, if an asset class is yielding 13% and it typically has price losses of 0 to 4, that means we've consistently harvested 9% plus from this particular asset class. And it's actually starting to show where locally in the 2 years we've been de-risked, global local bonds are our best performing asset class. And then finally, gold. It has done phenomenally well since we added our exposure again around 2022. You can see we really were spot on. It has been a bit volatile and rough, but generally it's gone up, and I think it's got further to go, especially once the dollar starts to weaken, as well as when interest rates start to be cut. So if I summarize this and you look at ideas which are either in bear market territory, you'll find that our investment strategy in terms of depressed ideas, which we love going forward, the answer is my gold, my China, my bonds. If you just say that, then you know what we love. And then over and above that, we're gradually adding to South African asset classes, because they pretty much have been underperforming alongside gold and bonds, all else equal. So to finish off, just get out of our investment risk signals and look at what our external research providers are saying. Alpine Macro argues that we are going to have a sell-off in the S&P 500. So if you look at where my cursor is, they're expecting about 8 to 10%. So those drawdown charts I showed you, many of our markets are going to end up in that red text box if Alpine Macro is correct. However, they believe that this particular sell-off is going to cause a rotation, where bonds, where global equities, particularly DM equities, are going to give way to bonds and gold. So they're expecting this rotation in the immediate 3 months. So again, voila, our strategy, I think, is going to get good support all else equal, they're a little bit schizophrenic when it comes to China. The 1 week they'll produce an article where they really love it. The 1 week they'll bring an article where they really hate it. So we don't know exactly where Alpine Macro stands concerning China. Otherwise, I would have extended another green arrow so happily, but obviously we did not. I think just to sort of remain honest with you. So Alpine Macro also believes that this sell-off is going to create an opportunity to then rotate out of bonds back into equities. So they really think this rotation is a short-term thing where you need to buy bonds now, wait for about 3 months, and then get back into equities after they have a sell-off of at least 10%. So that's what they are saying. They've obviously been asked to say, is there a possibility that it's not a correction, but we're going to enter a downturn exceeding 20%? And you can see, I can't really show you, but if you look at where my cursor is, the answer there is there's always a risk of a recession. So kind of saying, we don't want to say that's not going to happen, but our base case is this red text box where there's going to be a rotation, but then it's going to be a correction. And then we have an opportunity to buy into equities, especially if you have not managed to participate in this first particular bucket. BCA, on the other hand, believes that definitely we're seeing a rotation out of DM into DM equity into DM bonds. They were negative on property until yesterday. I think their recent piece on yesterday upgraded property, which is quite a surprise for us, but exciting because I think it confirms where we are. They are not that vocal on China. So again, the arrow does not extend to China. They do mention it in a slightly more consistent view than Alpine Macro. They're generally warm and positive towards it, if I have to maybe give that take it that far. But the key point I really want to leave you with is that our BCA makes a strong call that the bull market we started in 2009 is pretty much over. So this is what they're saying. And they're saying in this sell-off that they see coming, don't rush to buy back in because it's going to be a prolonged downturn. They actually expect, if you look at where my cursor is, where I'm kind of moving in so you don't miss it, they expect the S&P 500 to drop to 3750, which is a 32% decline from current levels. Obviously, for Apex PMs, it's like, yay, finally our calls are coming through. So if we do see this 32% downturn, maybe it's 32 champagne bottles getting popped. Obviously, we're not drunkards, just one is enough. But I think it gives you a sense of where we are with our house. We're in the last penultimate stage of that, where DM equities kind of have to give some ground to bonds, and we're really well positioned. And in this quarter, we're just saying, please, this is your last chance to add those global bonds, those global IOBs, add that gold, add a little bit of property if you're not in line with our house view, because we may not have that opportunity again. So I'm done with the past performance. I'm done with giving you a sense of where we stand. As is usual, we have to go through our 7 pillars. I know that I've got roughly 15 minutes to go. And fortunately, the presentation is designed to just give high-level summaries. So don't worry, I will make my time. I'm not going to keep you longer than 1:15, just based on my understanding of what we have to cover still. So with Pillar 1, ultimately, Pillar 1 is about saying, is inflation giving you a good message around the quality of growth and policy, or is it giving you a bad message? When inflation is above target, it's a bad message, and policy must come in and rein it back, which is not good for growth assets. When inflation is low, that's a way of saying the policy settings are great and the growth is going to be great. So growth assets are going to be great. So essentially, when it comes to Pillar 1, we just want to know if inflation is behaving or misbehaving. Then we will know if all these other things are good or bad. And so that's essentially what Pillar 1 is all about. So given that it's all about using inflation as a barometer of growth and hence a barometer of our appetite towards growth assets, what is this barometer saying for this particular quarter going forward? For China, the barometer is saying your inflation is now good. You can see in all these cases, inflation is the apex orange color, and then the gray broken line is the target. So it's behaving properly. It's just that monetary policy is taking its time. We think that China is waiting for the US to cut, because if they cut before, their currency is going to weaken, and then the US is going to say, oh, they're manipulating the currency. And we think that they're sick and tired of that accusation. So they'd rather wait for the Fed to cut, then they'll cut as well. So I think we might see these rates being cut once the Fed start being cut. We don't really care when they start cutting. We just love the fact that the distance to inflation is a big one, which means that the upside for growth sides is also a big one. So we remain very, very confident that our call for China will eventually come through, and maybe to be my China, my China, my China as we pop those bottles. And then if you look at South Africa very fast, South Africa is back into the inflation band. You can see it's inside, which is great. And what is clear to us is that these policy settings, the highest we've seen in 25 years, are no longer worthy for where inflation is. So these, I think, need to be cut back, even if they just come back to where we were at 7%. So we're pretty much seeing almost like a 2% rate cut in SA just to get back to prior peaks, which we argue again, these are way too aggressive for inflation is. So again, China and South Africa, a lot of room to cut rates. We know these two central banks are not going to cut before the Fed. It's clear because they have to control and manage their currencies, and weak currencies in China or South Africa will cause inflation. And because these central banks are quite dogmatic around inflation, they're going to wait for the Fed. And to the extent that Jeremy Powell yesterday said September is possible, it's just really a party waiting in terms of our house view. And if you look at the US again, you can see that the highest rates in over 25 years, actually in over 40 years, if I have to go back to other charts, what we like is that inflation again has really come much closer to the 2% target. We're still seeing disinflation, although a bit frustratingly slow. What is very obvious, however, is that the current interest rates are a bit too high for inflation is. So I think Jeremy was right to say maybe it's time to consider cutting rates, because if they take too long, these rates are causing a lot of damage to the underlying economy. They may not be able to secure that soft landing, which they are sort of about to secure. Europe and the rest of the DM is actually a lot closer to their targets. Again, there you saw the ECB starting to cut rates, and then yesterday you saw the Bank of England start to cut rates. So essentially, we can argue that the aggressive monetary policy stance in the Fed, which is a trendsetter for the rest of central banks, is literally too and now unnecessary. And we think rate cuts are closer more than at any other point in time. So let's maybe just have a quick chat around why do we think rate cuts are very good. Right now, I've got three different text boxes in front of you. These three text boxes are all designed in an interest rate increasing environment. So if you look at this particular first text box, your interest rate is going up from 5 to 9. In the second one, it's going up from 5 to 9. In the third one, it's going from 5 to 9. What separates these different text boxes, however, is that in the first one, your earnings are declining by 10% of the base, which is 10% of 1,000 every single year. So 10% of 1,100. So they drop from 900 to 800. So here you've got the combination of declining earnings and high rates. The second one, you've got stable earnings and high rates. And the last one, your earnings are growing, but your interest rates are being increased. What you see is that the price change, the effect of an interest rate cycle is negative regardless of the direction of your earnings. And what we really want to leave you is that the current rate hiking cycle we've seen in the last two slides has been a major headwind for growth assets. But the fact that all of them have peaked means we're now past the worst in terms of that. So one of our key messages for this particular second half of 2024 and next year is that we're past the worst as far as this effect on growth assets is by monetary policy, which is a good reason, I think, to be bullish. And to think about what is going to benefit the most out of this, again, my China, my bonds is well positioned for this. So we really think our strategy is going to work well. And gold obviously loves a rate cutting cycle. So essentially, gold is my China, gold is my bonds. That I think is the right place to be at for where we are in the monetary cutting cycle. In terms of where we are in terms of our process, anything that is negative is not a good thing. The most negative remains inflation. However, if you look at this number in the context of the direction of those charts, I think it's a fair comment to say, although it's negative, it's actually going or moving in the right direction. And then geopolitical risk is negative. We've got no control over this one. So whilst we note it, we can't do anything about it. So I think we'll just leave that one as it is. And then if we then look at what Bank of America Merrill Lynch is registering as the biggest concerns, I guess, from June 20, the biggest concerns on a forward-looking basis, you will see that it's inflation, it's recession, and it's geopolitical risk, which again are the same things that our signals are picking up. Inflation, geopolitical risk, and recession is obviously something we cover in the next pillar. I'm not going to really say much around the US elections coming up in November, but the one word that immediately strikes your mind when you talk about Donald Trump is your tariffs. So if you look at the red line, which is your tariffs inverted, which means that when the red line is dropping, tariffs are being increased, and when the red line is flat, there's nothing happening to tariffs. And then again, when it's dropping, it means another significant increase. What you will pick up is that every time Trump imposed tariffs on Chinese goods, the prices of those Chinese goods fell down. So for example, during his term, Chinese tariffs increased fivefold and the prices fell by 2%. Reason really just becoming that tariffs, not Trumps. Actually, those sounds like the same thing. Tariffs are like a tax, and the tax affects disposable income. And when you reduce disposable income, you reduce aggregate demand, which is disinflationary. So in the context of the excitement that you've been sensing from me, to the extent that any further tariffs, not Trump's, are imposed, if he does come to power, if being the key word there, then it means it will be disinflation. Again, it will not stop the fact that as far as monetary policy is concerned, we are past the worst. So that's our only conclusion for pillar one. And then moving into pillar two, good news again. The good news is that emerging markets global macroeconomic scores bottomed out in the first quarter of 2022 when we started our de-risking cycle, which essentially explains why we were never really afraid of EM. We kind of kept it at neutral and didn't tamper with it. It did bottom out in the first quarter of 2022. 2 years later, it's clear that it recovered a little bit and it stabilized. So despite the strong dollar, despite the hike in interest rates, despite the negative things happening out of China, emerging markets stayed very, very, very resilient. This was not a 2-year period where emerging markets were supposed to stabilize before developed markets. So on that basis, you would know that Apex Investments Consulting has got a strategic allocation to emerging markets within its global equity carve-out. So we are naturally biased, but again, fundamentally, we're just happy to see this fundamental resilience, which means that if we start to see rate cuts, I think the growth assets here have got a lot of pent-up fundamental strength that is going to be released in exceptional performance. And we're pretty much waiting for that champagne bottle, but it's too early. For now, our focus is on the bonds. Developed markets, fortunately, also look like they bottomed out 2 years later in Q1 2024, which is where my cursor is right now. We did talk about this bottoming out in our commentary last quarter. We were not so sure if we'd have a repeat, but guess what? We've had another repeat in the second quarter, which is our current reporting period. And also up to now, they look like there's stabilization. So we think that our pillar one scores have sort of stabilized. So we've achieved that soft landing. If the Fed starts to cut rates as early as September, I think the stabilization is intact. If they take too long, I think they're gonna lose the soft landing that at this point in time they've achieved. And that's the $1 million question around us becoming very bullish on this particular one. We also have other good news. The main reason why we de-risked our portfolios in May is because if you sort of go back to this particular chart, you will see, if you look at the point, the zero line, which is where we've got this broken line, the first time that the zero line was crossed was in May. We waited for a bit and then it kept signaling that danger is coming. So essentially all the way, this particular line kept getting worse and worse and worse. And essentially when this line is inverted, it means earnings are going to collapse, economic growth is going to collapse. So we became defensive, and hence the consistent reference to May 2022, it pretty much was, yeah. And then what has happened recently is that the danger signal has moved from -3 to -2. So it's still dangerous, but it's improving, which might mean that our major recession signal, just like pillar one, has bottomed out. We think pillar two has bottomed out, but it's too early to say. It's really too early to say. Let's see what's going to happen. But again, if we have rate cuts, that means your 2-year bond yield is going to drop. And this, if the 10-year does not rally quickly enough, this becomes an uninversion. So rate cuts and uninversion are typically synonymous with one another. So again, we think we're past the worst in terms of pillar one and pillar two, which means the team is starting to breathe a little bit more normally, all else equal. We built this 13 re-risking criteria. The interesting part is one more was triggered this particular quarter, and the one which was triggered this quarter was point number 7. And point number 7 is about emerging market earnings bottoming out. I'm going to show you that a little bit later, but it is clearly done. We think that there's only 2 or 3 left. Why do I say only 2 or 3 left when I've got 3 in here and another one to come later? It's because pillar one and pillar two, we think it's a given, where pillar one and pillar two have bottomed out. We just want one more confirmation. And then the Fed communicating their first red card. You heard him yesterday. He kind of said September might be the time. So it has been communicated. We just need conviction. And the signal really wants communication and not necessarily the cut. So we're quite happy about those two. The ones which we don't know is if we're going to have an inversion. And the second one is when we have a strong bond market rally, because the strong bond market rally is the evidence that cements that it's over to be defensive, now move on and become aggressive. So we've got two to go. It's exciting. And obviously, as we've been triggering a few things, we've been making the right asset allocation calls, which is why I keep on referring to our process as systematic. We don't have a scenario where client A is given one decision, client B another one. It's pretty much more like a McDonald's, where you've got the same experience of the quarter pounder, regardless of where you are in the country or in the world. So again, we're quite proud to say in this past couple of years, as the triggers were signaled by the process, we were making the scheduled calls according to process. And I think that's been, a remarkable thing, all else equal. So now let's talk about this communication of the interest rate, which the Fed did yesterday, or hinted at yesterday. Is it something that is going to cause a dramatic change in our portfolios? Maybe I should rephrase the question and say, why do we have Fed communicates and then we say we will still continue to gradually close our underweight to property? Why gradual and not fast? Because aren't we all waiting for rate cards? I think that's $1 million question. And if you look at this particular question, I'm only going to focus on chart number 148 and chart number 149, which I know that you're very familiar with because we've been referencing back to this empirical evidence throughout the last 2 years or so. The way to read this chart is that this is pretty much about 60 rate cuts and 60 rate hikes that have been done by the Fed over its entire Fed cutting cycle and Fed hiking cycle. The gray line at the top is your upside scenario 12 months after the first rate cut. And the other gray line is your bottom side or downside scenario. So you can see that 12 months after the first rate cut, markets are either up by 20% or down by 30%. So it's asymmetric to the negative, and the average experience is that markets are kind of flat. So this is just a way of saying to us, yes, we will change the positioning of our portfolios if the Fed communicates a rate cut, but we're not going to do anything drastic, because the first 12 months after the first rate cut is not where the deal is. The real deal actually is the 12 months after the final rate cut. So excitement comes much later in the rate cutting cycle than much earlier. And if you look at the best scenario, 12 months after the final rate cut, you've got upside of up to 60%. Who wouldn't want that? And then the worst case scenario is about 10%. That's also really good. And then on average, markets are up by 30%. So essentially, when re-risking is most powerful is when the rate cutting cycle is maturing and not when it's quite early. And if you think about it, the more you hike rates, the more painful you make interest rates in the whole country. And when you cut them, it takes a long time for the average pain to drop to manageable levels, which is why the first 12 months are not a time to be excited. But the 12 months after the final rate cut is where essentially you now want to go into overweight with your growth assets. So essentially, we just want to let you know that although we might be taking this particular re-risking criteria, you can see when you look at the scheduled calls, it's just still going to continue to add to global property, but slowly, I think being the key message, because we really don't think that this is the time to be excited. So we welcome rate cuts, but the truth of the matter is that actually much later is when you need to start getting excited, because right now we need to figure out, are they cutting rates because they've achieved inflation, or they're cutting rates because they've broken something in the system? And that $1 million question is why you never have any movement in markets, and why the scenarios are so as wide as they are, or as uncertain as they are. We also like this chart that has come from Fairtree, where they look at credit spreads. And the most important point to note is that this blowout in credit spreads, where these bars jump up, typically happens a lot later into the rate cutting cycle, not early. So the pain is later. So again, we're just saying, let's just hold our horses. We love the rate cut decision, or the communication, or the hint, or the suggestion. But in the bigger scheme of things, my gold, my China remains the better things to focus on, not yet on credit. and net not yet on DM equities. And then the last one is your stock to bond ratio. When this moves away from supporting bonds and starts to support equities, then we know we are done with re-risking. Right now, everything about the stock to bond market ratio suggests that bonds are better than property and bonds are better than equity. So again, unfortunately, we're still the global kings, global bond kings, as far as this idea is concerned, but for the right reasons. Once this is triggered, we're going to close our bond allocation and start to load up your portfolios with property and equity, but we're really not there. And it's again not going to be an emotional decision, because you can see there's a clear trigger, there's a clear scheduled call, and the PMs have to battle out why they want to override the process in the meetings that we have on a quarter basis. All in all, what we're really trying to do is we're trying to position portfolios so that we participate in the first decile. I've already communicated that. So far, we got it quite nicely for South African equities. We've only managed to get it for A shares in China, but not the H shares. Emerging market equities, the jury's out. For property, we nailed it. We got it right. For bonds, we got it right. For IOBs, we got it right. For the Rand, we got it right, but only in the last 3 months. So far, we are getting this first part correct. We just want my China, my bonds to conclude that we got it right. And obviously, I showed you the drawdowns are starting to happen for equity and credit. And if we get this right, and then all of a sudden you see the significant improvement in our performance track record, which in the last 2 years has just been something not so pleasant to look at. But I think as the things are starting to work, it proves the fact that stick to process and you will do very, very well. Recession risk signals, although they've improved, they're still in the negative. So we are quite aware that it's a bond bullish environment because of high recession risk. But when there's high recession risk, the odds of an interest rate cut are very, very high. So now that we think that the odds of a rate cut are very high, let's just have a look at what happens when we spin around and we now look at rate cutting environments. So if you look at this particular part, our rates are declining from 9 to 5 in the first scenario, where we've got a combination of declining earnings and declining rates. And what you see that as long as rates are declining, it doesn't matter what happens to earnings, the impact on price is positive, but maybe not too positive. So if we have this combination where earnings in the US are coming down and the US is cutting rates, these numbers of 1 to 8%, we know that bonds can do better. Hence, we love bonds in the DM, but not anywhere else. If you keep your earnings stable and you cut rates again by the same magnitude from 9 to 5, you can see performance is anything between 12 and 80%. We love this. We really, really do love it. So we think we're starting to enter into an environment that is asymmetrically in favor of growth assets, especially those where the earnings are bombed out, like South Africa, emerging markets, and China. Then the last cream de la cream of our macro regimes is where the earnings are increasing and the interest rates are being cut. There you can see that the performance becomes crazy, where the upside is as high as 152%. So pretty much you're doubling your capital. So the message we really want to leave you with again is that as far as interest rates are concerned, we are past the rate hiking cycle. The Fed has communicated that we're entering the rate cutting cycle, and all 3 scenarios of rate cuts are bullish for growth assets. And what you really want to do is you start to gradually add to those growth assets, which we've been doing for the last 3 quarters. So in this particular sense, we're very, very excited about your portfolios. We're very excited about the signals that our process is giving. And I think you'll be proud of us 2 years from today. So if you look at where earnings are for South Africa, they are bombed out. So the higher case probability is that as the sub is cutting rates, your earnings are increasing because they're coming off a low base. So South Africa, we think that it's going to coincide with the Fed cycle in a good way. Emerging markets, we think they're going to coincide with the Fed cycle in a good way because the earnings are already bombed out. So we love this. China is so bombed out. It's going to be cream de la cream fun. We love this. And in developed markets, much to our expectation, you can see that our earnings are starting off a peak. So we might have the combination of declining earnings because of mean reversion and declining rates, which gives you good numbers in the sense that they're not negative, but I think they'll be underperforming bonds, and hence the combination again of my China, my bonds. So we really think that developed markets, the earnings need to normalize a bit, and then we'll start to become excited about them. And then if you sort of look at developed markets, excluding the USA, again, the earnings are at the peak. We really wanted them to have bombed out to be bullish about the combination of recovering earnings and declining interest rates. But you don't really have that lovely combination within developed markets, so much that if you summarize it, We believe that we're at the beginning of a rate cutting cycle across all the geographical regions, but the starting point for earnings in the developed markets is not good. In emerging markets, kind of here and there. And then for South Africa and China, it's actually really, really looking good. And that's a very good thing for us. If you look at currency again, we're starting off the worst case for the rand. It's really so weak. And I think about to start to enter a recovery phase. So obviously a recovery in China, a recovery in EM, a cut in rates by the Fed is bullish, or else equal. So we might actually see an extended period of rand strength, which is why we do not have offshore that is more than 30% in our portfolios. This particular chart gives you a sense of how much stronger US fundamentals are relative to the rest of the world. 0 means that they're the same. 1 means they're strong. 2 means they're very strong. 3 means that they're extremely strong. Currently, they're at 0, which means that the dollar does not actually have fundamental support for its valuations, which means that the probability of a weak dollar, all else equal, is quite high. And if the probability of weak dollar is quite high, then the probability of a strong rand is also quite high. So again, as far as the rand is concerned, we also think we are past the worst and we should see some rand recovery, which all else equal is going to be bullish, I think, for South African assets. I'm going to skip a few slides and just almost close off and say, monetary policy-wise, it's a green across the board. Trough earnings, DM is a concern. Currency risk, we think it's bullish for the Chinese currency and the South African rand, but not really for the dollar. And emerging markets are sitting somewhere in between those two. And then if you then look at asset class valuations, here we're going straight for our scorecard, which ranges between -3 and +3. For South African equities, the score suggests that South African equities are still very cheap. They were extremely cheap last quarter. We had that first bounce, which we got, thank God for that. And they're now very cheap. They still have to move to cheap, then to fair value, and they might even become expensive. So we're seeing quite a lot of upside. And all in all, a lot of green shoots across the South African equity markets and its underlying subsectors, which is why we're gradually adding to this particular asset class. On the offshore side, unfortunately, everything is extremely expensive on DM and USA. Emerging markets, not extremely expensive, just borderline expensive. And then China and global property are pretty much on the cheap side. You will see that emerging markets were fair value last quarter when we met you, because of the rally that they've had more recently. They've moved into expensive territory, and we're going to take a little bit of profit out of emerging markets and allocate that to developed market bonds. And then when bonds rally, we'll bring it back to emerging markets. So you're going to see one of our closing recommendations is a marginal profit taking out of emerging markets to take advantage of this movement from fair value to expensive. And then we'll bring them back once the score changes, which might be next quarter or the quarter after. On the global side, nothing really exciting, to be honest, with the exception of small caps, which explains why we want to rotate into small caps after our bonds have rallied. So that will be the next idea. So there will be the kings of small cap and the king of value, but not quite now. And property, you can see, regardless of the geographical region, it has very attractive valuations. And then if you then look at indices versus the O share, it's not worth taking money out of South Africa into any of these equity markets, with the only exception being China, where things are fair between China and South Africa. So we're very indifferent between those two ideas. And then if you look at the developed world versus the rest of the world, you can see that you don't really want to be in the US. You don't want to be so you don't want to be in the US, and everything else versus developed equity markets looks very cheap. But the problem is that when you bring all of these things against South Africa, the story changes, where you're only left with China, or else equal. So if we sort of conclude from a valuation perspective, South Africa, you can see the scores are 1, which is an overweight of 5, 2 is an overweight of 10. But we're sort of gradually getting into these overweights. We're not going to rush it because there is this indeterminable or uncertain outcome around. Are we about to cut rates because something was broken or because inflation was attained? If we knew nothing was broken, we'd be overweight. And the only time we're going to know that nothing was broken is when the bond market uninverts, which is why it's still unticked in our re-risking criteria. If we then look at bonds versus equities, the equity risk premium is negative. Negative means that equities are not pricing any negative surprises, and therefore the equity risk premium is negative. It needs to be positive to reflect that earnings are also admitting that maybe we're about to cut rates because something was broken. As it stands, equity markets are saying things are perfect, which is not normal, and therefore the reason why we prefer to be in bonds and not equity. And if you do the same thing using the MSCI World, again, you end up with a bond bullish environment. And then if you sort of look at the different valuations like we do, and you look at different areas, you will see that again, the developed market side, the US part is where we've got very negative scores of -2. Everywhere else, they're kind of here nor there, but the DM side is very, very expensive, and it has continued to rally against these expensive valuations. If you move on to granular asset classes, inflation linkers in our universe, they've got the best score of 3. So again, we really love ILBs on the local side. We love ILBs on the global side. If something is broken, those real yields will rally aggressively and we will make our money. But because we don't know if something was broken or not, we just have to keep our overweight and let time, I think, give us the answer. So to close off on valuations, the only thing going for developed market equities is that they're about to have rate cuts, but the earnings are at a bad starting point. The currency is at a bad starting point. The valuations are actually demanding that we underweight by 10%, and the rest of the world is actually looking quite good, with a lot of greens in China and South Africa, which again is reflecting our risk appetite. We are unfortunately not overweight in South Africa yet, because we don't know if something was broken in developed markets. And you all know the old adage, when the US coughs, the rest of the world will catch, when the US sneezes, the rest of the world will catch a cold. So we do know that if they sneeze, then we're all going to get cold. So we can't get too excited about our greens, but we're gradually getting excited about our greens, all else equal. And the only time to know if we should be excited about our greens is when DM bonds rally, which again is why we're very bullish on those bonds, a message I think I've been saying throughout the presentation. As far as regional exposure is concerned, you get the same answer. So you can see that when you bring in pillar 1 scores, pillar 2 scores, pillar 3 scores, pillar 4 scores, which are essentially these 4 different scores at a geographical area, your answer is such that on the DM side, in fact, everything out of South Africa is negative. The only exception there is China and South Africa, which are not. And hence the reason why we're saying we would only get to 5% overweight offshore if our clients have accepted the China core, outside which we would rather be at the neutral of 30%. Then what do we do with developed markets which are negative at minus 1.71 or minus 0.92? What should we do? Because this is a big underweight of 5% for the 0.92 and almost 10% for the minus 1.71, because now you're underweight 10% by something that is defying the odds. If you go back to 1995, like I mentioned earlier, this was the last regime where we were higher for longer, which we've been experiencing. There was gradual disinflation there. The blue line is the 1990s, the red line is currently, and we've had a little bit faster disinflation like then. And then you can see how the S&P 500 was a big mania. It kept rallying and rallying and rallying, regardless of expensive valuations. And we are roughly 1/3 along that mania path. So if you don't position for a mania, and it means that you could lose out for the additional 2/3 of strong outperformance by an expensive asset class. Whereas if you position for it, you might have to be very careful in case it doesn't play out. What was the reason for the mania that we saw in the mid-90s? It's because there was productivity benefits that came out of the internet boom. And you can see how long this lasted. And right now, the AI boom is following exactly the same pathway as the internet boom. So what we do know is that we don't know for a fact if we're going to have a mania or not, and how far AI has to go. No one has the answer, but I think the common answer from all managers is we're in the very early stages. So if we are in the early stages and this AI boom has the same effect of causing a mania or an asset class that does well from expensive valuations that it had in the mid-90s, then if we are premature and we respect our process like the way it suggests, we're going to be underweight a mania, and that is a very painful process to be at, especially if the mania controls 70% of your developed equity market indices. So that's sort of where we are, just around that US. It's a bit of a painful place for us to be, all else equal. And then if we sort of finish off with global investment styles, again, speaking to the mania, we are aware that your growth and quality managers are the expensive areas, but if you're not overweight those and it's a mania, you're gonna struggle. So just to finish off, I think in terms of our topical exposures, we do know that once bonds have rallied, we're going to need to have quite a good allocation to value managers locally. And there we're looking at managers like Contrarius, Orbis, and T. Rowe Price. Because we're still bullish on bonds locally and globally, we love those. But once they rally, we're going to have to look into small caps on the local side. And there we're looking at Investex, BCI Dynamic Equity Fund, one of the strongest small mid-cap capabilities in the country. The Satrix Mid-Cap does the job. Sim Small Cap Fund, one of the longest, most established manager in the small mid-cap space in South Africa. So these are the managers we'll be looking at once we're closing our bond call. And on the global side, we'll be looking at global small mid-cap managers like Addison, Driehaus, as well as Dimensional. So we're really starting to build some excitement. But for now, it's my China, my bonds, and then it's going to become my value, my small cap. And we keep on rotating those ideas as they sort of come through. In terms of other topical exposures, the bond side, I know we've sold bonds aggressively to you, but we're not going to stop because we're so excited, especially on the global side, because the local side is finally played through. And maybe that's why we've become a lot more confident. And we do think that that's going to come through. So we still love bonds and we've got nothing much to add there. Positioning, we still have argued for our investment objectives. Please send your questions. Please send your suggestions around how you want to temper out our investment objectives to better suit your clients and to better suit your business. And then when we come for our investment committee meetings in the coming 4 to 6 weeks, we'll bring that optimal balance that works for your clients and that works for your business and that works for my bonds, my China, all else equal. We are going to sort of translate the my bonds, my China in a very systematic way to 30 mandates so that everyone has an experience. The quarter pounder will taste the same in Cape Town as in Joburg, as well as in Paris, because I guess we're trying to just build a very good experience across our client base. In terms of ideas, we're very indifferent what you like, whether it's South African equity, South African bonds, or Chinese equities. We think they're kind of linked to each other. So whichever you think you really like there, we will support you. However, our default position, we will always want a slice of every driver of performance. Otherwise, then the whole word multi-manager loses its essence if we start to pick one over the other. All of these have got good upside. All of these are being driven by different policy decisions. And we don't know which one is going to perform strongly in the coming year, but all of them have got a good starting point. But for your preference, as you adjust our views to your clients and your business, is that we don't really mind which of these three you prefer the most. We do argue that please go make sure you overweight your duration risk by half a year to 1 year. Please, 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 because we are so bullish on bonds. And look at our duration, our neutral duration levels. Look at the calculation of your blends and make sure you're overweight, because we may not have such a lovely opportunity to be overweight bonds in a while. Because as you have sensed, the next ideas we're looking at is your value managers, your small mid-cap managers. That's where you're going to start to allocate money, as well as your local and property managers. Do not capitulate no matter how painful something is. Rather go for a gradual reduction to half of the original position. And once things turn around, top it up, because many times things that funds that are capitulated out of do better than any other option that is bought at the point of capitulation. We don't want to be part of such a horrible statistic. So please, please, please just know your PMs are going to fight you from complete capitulation, but they'll support gradual reduction only for 50%, not for the whole thing, because we don't think it's a prudent thing to do when you're a long-term investor and claim to be as such. For multi-asset portfolios, we haven't changed our views. So I'm not going to take you through any of this. I mean, it remains the same. Underweight the growth styles in favor of China and bonds. I guess the my China, my bonds comes through in this particular portfolio. And then again, for the specialist building block, the very same things we're advocating for last quarter, we're advocating for this quarter, except that we are building up more conviction on the DM bonds and the DM nominals, because they haven't really come through the way that we want them to come through, but we started to see drawdowns out of DM equities. So that development we've seen in the last week of July and so far in August. I know it's only 2 days because today is the 2nd, but those are sort of giving us conviction that finally DM bonds and DM ILBs are coming through. So if you just get a sense of what's going on now, there's a slight tweak. If you look at emerging market equities, they're outright neutral for the longest time. They've rallied into expensive territory. We do think if the US sneezes, everyone is going to catch a cold. So yes, we're expecting a sell-off in DM equities, but you also saw South Africa has been selling off. So people tend to sell off when the US is selling off. So on that reason, we're going to tactically avoid EM equities by only 2.5% maximum. And we're going to take that to bonds, which you can see were 5% last quarter, and they become 7.5 because the bond call, we're really pushing that quite aggressively. So that's the only change we're making this particular quarter. The rest of them remain the same. It's pretty much our gold is my China and gold is my bonds. That's the idea. That's the strategy. And in the middle of that, we're gradually buying asset equities. We're gradually buying asset property. We're gradually buying global property and property because it's a hybrid of bonds and equity. So you really want to play into the bond nature of property. And I think that's pretty much, I think, going to be the story. On the global side, it's the same thing. Have that marginal reduction out of EM because of the same reason, and make sure that goes to bonds because we've become even more convicted that this is time, I think, for bonds to do well. I'm going to close off on this note. I think there's two Apex portfolio managers on all of your accounts. Please reach out to them for all the areas or sections of this presentation you did not understand. For your particular meetings, we've got a much, much shorter version of GIS, so we won't really go through all the details because the idea is to focus a lot on your portfolio. So please start emailing your questions where you've got suggested changes that you want us to discuss and even approve before the meeting. We prefer that because we're not price makers as far as markets are concerned. We price takers, so we want to move as fast as possible. So whatever suggestions you have for your positioning that you want us to attend to, please email that to us. We'll make a decision. And by the time we meet you, we're just verifying if we're still happy with the portfolios. Thank you so much for spending, I think, the last 1 hour, 25 minutes with me. I really, really appreciate it. And on behalf of the Apex Investments Consulting team, thank you so much. And remember our strategy, my gold is my bonds, my China. Hopefully when I see you next quarter, I don't have an egg on my face thinking, why did I over emphasize that? But again, I think we'll continue to do that because that's what our process says. Have a lovely, lovely weekend ahead. Cheers.